Bitcoin has a roller coaster of a day as it dips below 90K and then reverses sharply higher as risk assets rally on the prospect of more measured tariffs from Trump. High bond yields and a strong dollar will keep investors nervous ahead of CPI data out this week. And options flows become more balanced, with put buying activity rising and calls getting sold. All that and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave here in the studio from FRNT. And just before we start, I want to announce the winner of our giveaway that we did on the Christmas episode where we're giving away a Padel racket. Congratulations to Sophia Antoniou 5433. There will be something coming to you in the post soon. Okay, cool. A bit of a wild ride in Bitcoin, huh?
Are you not entertained,
oh my God.
Imran? Are you not entertained?
Not really, no. It's annoying me.
we said some volatility might pick up around the data last week. In fact, I think as we walked out the studio, things started to dump because the bond market started to turn, and we had that really strong ISM services print,
and then stronger, really hot.
So kind of the bond move definitely has caught me a little bit off guard, but I think that's kind of been driving everything right now.
For sure, the macro's feeling a bit scary right now.
Yeah, I mean, really, ultimately, stepping back, we're just in a bit of a chop. Like, you know, we've kind of had this massive move post-Trump. Hit some highs around 108K or above, whatever, and now we've obviously you get a little bit of leverage, gets washed out, and then we're chopping, like, and it is quite choppy, right?
Yeah, I mean, yesterday it broke 90K and then boom, before you blink, and it's 97K.
Which to me is interesting because it speaks to there's still this real underlying demand. Like I think that's why I'm still feeling very bullish. I know there's lots of calls out there now for like just from a more sort of technical point of view that we go back to like 70K would be the pullback. I saw like Tommy Lee from Fundstrat talking about that.
70K.
Yeah,
that's quite a deep pullback if it gets
quite a deep pullback. Not out of character for Bitcoin in a bull run.
And is the idea that happens over the next couple of months?
Yeah, I guess so, right? I just personally don't see it because I just think there's this real demand still coming in. And I think that paradigm shift, like post the Trump administration, is just still going to bring in more money off the sidelines and coming in. And I think we're probably underestimating that still. So, I mean, I'm tempted to say we've probably seen the lows this week. Much obviously depends on the bond market. And that's probably the focus right now.
Everyone's a bit scared of inflation, right?
Yeah, so the bond market. So I guess like that's what we need to understand, like what's driving that sell off. And there's kind of for me there's kind of three things. Certainly the last week or so. Firstly, we've had this sort of stronger data pulse. So if you think the Fed cut 50 bips in Sep because the data started to really like deteriorate, panicked a little bit, cut. Anyway, since then, we've actually seen this kind of resilient data pulse. Like the labour market seems to be stabilising and it looks quite strong. Inflation, they talk about that bumpy phase. We're definitely in that. And that looks like maybe there's signs that that's turning higher. So the Fed obviously then flipped in December again and they've kind of got a little bit scared, turned a little bit more hawkish. So you've got the data side of it.
Only like one rate cut price for this year now.
Yeah, so we've priced out a lot of cuts. There's one rate cut priced,
and some banks are calling for zero, right?
Exactly.
Yeah.
So, but I mean, again, I think I'm quite disparaging of banks' research and that. A lot of them are just like momentum traders, right? Yeah. They just data's good. This pricing load of hikes. It's bad. I think we've gone far too far in pricing out cuts, and I can tell you for why. On that data, one of the important things to me is I think we're still living off the sugar high of the pre-election spending that ramped up, right? So we're seeing this strong data come through because a load of money was spent to entice voters into the election. So I think we're kind of living off of that. How long before that tapers out, I'm not sure. But I think we'll revert to that kind of slowing growth, not collapsing, but slow growth, disinflationary world as in. part of the reason I think that as well is just look at what's going on globally. Like China's in a deflationary spiral. The UK is struggling right now. Europe's struggling. So we've got a global growth slowdown, a global growth. Certainly China's emitting disinflation across the world. And I think that will continue to filter through. And I don't think the US is going to be immune from that, particularly with a strong dollar. So that will start to see, like, I think, a softer inflation pulse, I guess, in the US. The other big thing driving the bond sell-off is obviously Trump and the inflation fears and expectations, particularly around tariffs.
Which feel like they might be overblown because they're talking about measured tariffs, right?
Yeah, so I think that narrative's overblown for a couple of reasons. Firstly, like Trump, it's the art of the deal, right? He talks big, to bring everyone to the table, and we'll probably end up with something a lot less. And it's quite interesting that already yesterday those headlines suggest actually he's going to be a little bit more moderate.
That so much either.
No, he hasn't, right? But we know, he's a volatile character that if he's not getting his own way, he's going to write tariffs on everyone and just to focus minds a little bit. So firstly, I don't think they'll be as big as what we think. If they are, however, I think as well, it's a bit too textbook. It's a bit too textbook to think that tariffs are that inflationary. Like if you look at the last time he was in power and he whacked tariffs on, it didn't feed through that massively to inflation. And there's various things, like, because if you get a strong dollar, well, that immediately can offset a lot of the inflation impact. It much depends on the pricing power of the producers to actually pass this stuff on as well. And then also, if you've got a slow growth, like disinflationary environment, that kind of probably takes away that element as well. So I'm not kind of convinced by that. And then also there's this whole like make America great again, like just bring everything back on shore. Again, the evidence of reshoring during his last stint was pretty weak. And in fact, what we saw more was a reorganizing of supply chains. So if he was bashing China, actually some of the supply chains moved to India, Vietnam, and places like that. And then we also saw a move towards greater automation, which I think is going to be a big trend in a way over the next however many years.
With robotics and stuff.
Yeah, so which is disinflationary. So I don't think the impact's going to be as big in a way, even if he does go ahead with it.
So you're not a buyer of bond yields smashing through 5% and stuff?
The other thing that was big last week, and I think I overlooked this as well, so apologies, but so there was huge amounts of Treasury supply last week and corporate supply. So we've hit the debt ceiling, right? But I think the actual debt ceiling proper hits around like this week next. I think Yellen said around the 14th, between the 14th, 21st. So until we actually hit there, they're still able to issue. So the Treasury issued like 119 billion of new bonds into the market last week. Corporate issuance was high as well. And when corporates issue, typically most of the people buying corporate bonds are credit traders. So they sell treasuries to hedge out the interest rate risk. So there was a lot of supply last week, which I think added to that. And then the narrative took hold and the momentum took hold and yields are blowing out. So I kind of think it's overdone. I think it's overdone on the Trump thing. I think it's overdone on the US reflation narrative. And I think what's going on sort of globally will drag it down. And also what gives me confidence in that view is, look, like yields have been going up everywhere. And yet, Europe, UK, there's no sort of reason from a point of view of growth for yields to be going higher. Obviously, UK has got some of its own issues right now and the kind of whole debt dynamic. The other thing as well, with the debt ceiling hitting, they can't issue any new bonds. So net new bond issuance is going to go to zero, right? So that for me is positive bonds. So I think we'll see a turnaround both from the data and like economic surprises are coming in softer. So I think you'll see a softer data pulse going forward, which will cap out yields. And then also the lack of Treasury supply over the next couple of months, given this debt ceiling, will also see yields reverse lower.
So you're a buyer of bonds here. Yeah. But what is there anything that could make this viewpoint wrong, in your view?
Yeah, of course. Like if should well, a couple of things. Should the data actually just keep coming in strong, which I don't see, but obviously can happen. So should we see that data and we do price the Fed to zero? Who knows? Maybe start pricing some hikes. I think the bar for that is so high right now. if the debt ceiling gets lifted and then all of a sudden they're back to market and given the amount of debt they've got to fund,
though, right?
It will, but I don't think that comes until they've exhausted the TGA and all that sort of stuff.
Okay.
So I think that's a Q2 story.
Right.
But there's a chance that comes before, and then the Treasury are back in issuing bonds. And yeah, that could then continue to add weight. And I do think if you look at inflation break-evens, it's actually not been a huge inflation story. I think they're up around 20 bips since Trump came in. So there is also this whole sort of debt dynamic and debt sustainability dynamic. What that means for Bitcoin and why I kind of still like feel very bullish, certainly in this Q1. I mean, firstly, we got a huge like liquidity pulse that's offsetting those macro headwinds of the strong dollar and high yields. But I don't think the US or global economy can handle higher yields, right? We saw back in 23 when we started to push 5%, and Yellen came out and started kind of jawboning it a bit, and then we had the dovish sort of flip from Powell in December, where everyone's priced all of a sudden like 7 or 8 cuts for the year. If you remember that, kind of feels like we've done the opposite with last December. But I think things start to break. I think things start to break because the global economy simply can't handle rates that high. So what I think that means is I think that actually just leads us closer to the point of financial repression, of the Fed doing not QE type yield curve control, all that sort of stuff. Because I don't think it's a choice, that like we simply can't handle it. So I actually think that the more the bond market comes under pressure, the more, and the more we start to question that debt sustainability narrative. I mean, if you can't buy treasuries, then Bitcoin becomes the ultimate safe haven, because again, you're talking about the failure of like the existing sort of economic system. So I just feel at that extreme, we actually, now it might get worse before it gets better, and that could be a hit to risk.
I feel like the crescendo isn't there yet, right, in terms of higher yields. I don't disagree with you that there's a limit where we can't have yields this high. I'm not sure we've hit that yet. So I feel like there has to almost be a panic move higher in yields to really get us to that point where it's like they do whatever they have to do to get yields back again. Right.
So my kind of base view here is like, look, it's been a volatile as well. First couple of weeks, you know yourself, you've traded for years in these markets. First couple of weeks of Jan are always like really choppy, right? And everyone's trying to, just kind of like feel the market out a little bit. I think this move's gone too far, like too quick. I still think the course liquidity pulse is still very strong into the year. We talked about the RRP draining back down and coming back. We still base case for now is that we're going to be drawing down on the TGA. China are ramping up, so the liquidity element, it looks really good, looks really strong for Q1. And then I still think I think we'll see yields and dollar sort of cap out. This happened as well the last time Trump came in. We had this big move, and then actually it marked the top.
And the dollar then came back down.
Dollar came back down. Trump as well, right? Ultimately, his whole thing on tariffs, he wants to reduce the trade deficit, right? And he wants to export more. Now you can't want that and then have a stronger dollar.
True.
So Besant wants a weaker dollar as well. So it's either going to correct itself, or I can see some sort of, what I call Shanghai Accord, where they have to agree, because they're going to China, right? You need to buy more of our goods. And China go, okay, but we're essentially in this deflationary spiral. We need to stimulate, which is going to hit our currency. It's going to make a stronger dollar, but it makes it even more difficult for us to buy your goods. And we need to stimulate, if you want the consumer stronger, to buy your goods. The answer for everyone is like, look, you need to be able to stimulate, and we need to get the dollar down, and we'll help you do it. So I think we're going to see a lot of financial repression like in the next months ahead. I think liquidity is going to have to be added to the market. There's over $7 trillion of US debt to roll over. The Fed will be the ultimate suppliers of liquidity. So I think there's a lot of noise, but I think risk is going to be just fine. And I'd be fading this. And I think Bitcoin is going to outperform everything again because of that liquidity dynamic. We've still got to fund this debt refinancing cycle, and nothing's really changed. So I think everyone just relax a little bit.
Take a breath. Okay. All right, cool. Good macro update there. And today, this week, I got to catch up with Greg Magadini from Amberdata, and we got to hear his thoughts on what's generally going on in crypto. If you remember, he called the market very well when he came on last year, calling for 100K Bitcoin. So check out what he had to say. Okay, everyone, I have got an amazing guest lined up this week. We've got Greg Magadini of Amberdata, Director of Derivatives, no doubt, over there. How you doing, man? Good to catch up.
Yeah, absolutely. Good to catch up, Imran. Thanks for having me on. It was great last year. Happy to be here again.
It's a long overdue catch up, Greg. You know, I always love catching up with you, see what's on front of mind for you and what you're seeing, because we obviously both love options and love trading, right? So I really looking forward to this to see what insights you gleaned over the last few months in these crazy crypto markets. Now, I do want to say, I think about a year ago, you came on one of our early episodes in Crypto Options Unplugged, and your exact words were, by the end of 2024, 100K Bitcoin makes perfect sense to me. Those were your exact words. And my God, were you proven bang on the money. Huh?
Awesome. It's fun. It's fun to call a Delta play, right? That's cool.
It is nice. Yeah, it is nice to call it. But I mean, Dave's been banging the drum about it as well. We've all been bullish, right? So thankfully we were proven right. But now I think the easy money's been made, right? So we've now got a correction happening in front of our eyes. It's not been too violent just yet. But I guess my first question to you would be, you know, how deep do you see this correction going? Because, you know, we got to highs of like 108 and we seem to be wanting to hold the line at about 90K right now. Are we done here? And is the bull market ready to resume, or are you anticipating more weakness in the near term?
Yeah, I mean, the way that I'm looking at this is really, to me, this is doing sideways work. It's like a consolidation pullback. I mean, we're still talking about a 50 vol asset. So, you know, from 108 to 92, I mean, talking about maybe 20%, that's very reasonable. And I could see us, you know, doing a little bit of work post inauguration as well. Let's just keep in mind that, you know, Bitcoin post election, November 5th, really managed to move up essentially 50% from 60K to 100 pretty quickly on the back of a lot of enthusiasm, a lot of big headlines, promise of a Bitcoin reserve, or at least not the promise, but the speculation of it, a new SEC head, promise of lax regulation and David Sachs being the crypto czar, potentially some of the bank regulation to allow banks to custody crypto might come back online. A lot of these big headline events. And then you have Michael Saylor of MicroStrategy issuing a bunch of convertible bonds, selling equity to raise cash to buy more Bitcoin. I mean, that's a big, big buyer. So you got to start to think
enormous buyer, right? I mean, he's doubled his position in the last 6 months or something, hasn't he?
So in my mind, it's one of those things like, you know, is there anyone left at the margin to push this market higher, or is there time? Do we need some breathing room? And in my mind, you know, it's quite logical to see risk assets, which are having a little bit of headwinds with, you know, rate cut doubts post FOMC in December. There's some work to do. There's a little bit of a market digestion. So I think that's kind of how I see it. You know, I don't really think we go below 80K. I think 85 is probably like the spike below 90 that we get to. And I think we stay below 100 for a little while until market can find its footing again.
Yeah, I mean, I find it hard to disagree with it, to be honest. I think I agree. We've got to digest the quick moves that we got in Q4. And the macro narrative isn't that favorable right now, right? So the competing narratives, as you already mentioned, the whole Trump administration being more crypto friendly in general, wanting to kind of bring, you know, onshore some more crypto activity and more crypto business, make the US like a market leader. You know, he's a businessman at the end of the day. He wants business to come to the US. And I don't know about the strategic Bitcoin reserve. It's impossible to know, right? But like how serious they are about that or how big that might be. But the fact that they mentioned it is quite a game changer, right? The fact that sovereigns can actually consider holding it on their treasury, we would never have thought that was possible like a year or two ago, right? So the fact that is what they're talking about means that other countries could follow suit. So even if they don't buy that much, the US themselves, if they legitimize it and other countries be like, well, we probably need to have one as well, then I think that's a good signaling for the asset. But then the competing narrative of higher bond yields, bond yields are now pushing up close to 5%. The Fed is clearly a lot tighter than we expected them to be in terms of the latest pivot that they made at the meeting. So I don't think that goes away in the next few weeks, right? I think that macro narrative that is spooking the bond market probably has at least a couple of months to run out, right? Into March, maybe, right? At the earliest. So it's hard to be too bullish for Q1, but that's not to say we can't have a resumption of the crypto rally later in the year, right?
Yeah, exactly. Especially, from a Delta perspective, that makes a lot of sense. And then from a vol perspective, I mean, I think, MicroStrategy had peak vol post-election around 250% at the money vol for, call it 10-day options or weeklies. Whereas Bitcoin right now, it's, call it 50 vol, but realize it's maybe 45. But there's actually a lot of room to go down if we just go sideways. And so I think, if I'm kind of digesting what's an interesting trade here, is probably, using MicroStrategy as a leading indicator in terms of vol, and assuming that translates into lower Bitcoin vol. And my thinking there is that, Michael Saylor is issuing 0 coupon convertible bonds, while the convert value comes from the embedded option. And so if the embedded option has lower vol to it, that 0 coupon convertible is a lot less interesting. So if it's less interesting, is he still going to be raising capital as quickly, to buy more Bitcoin, so on and so forth? Does that strategy kind of pause a little bit? And then does that pause translate into a pause in sort of the Bitcoin market? It's maybe
you're saying the demand for the converts drops because the realized volatility of MicroStrategy is dropping, basically, right?
Yeah, exactly. The realized and the implied. Yeah, exactly.
Yeah. Okay, interesting. Yeah, I mean, it definitely does feel like MicroStrategy is becoming less volatile than the craziness that we saw, right? But what do you think in general? I mean, this is quite a good time to ask you. I'm curious. What do you think about the whole strategy that he has of like raising all this money and then piling into Bitcoin and then claiming that he's magically delivering like a Bitcoin yield and more Bitcoin per share to his investors, and that's why his investors should pay 3 times NAV for his stock? Like, do you call bullshit on that, or do you actually think there's some value in what he's doing for his shareholders?
Yeah, I'm not like an expert in this, but from my understanding, if you're selling shares at 3 times net asset value, and then the yield of the Bitcoin goes up, ultimately what you're really doing is you're reducing sort of the embedded net asset value premium till at some point, it should, like, if that net asset value premium holds, at some point you can issue so many shares that like you buy enough Bitcoin to make it parity net asset value. So to me, math is math. So there's no like magic money coming from any source. Really what you're doing is the net asset value premium is kind of finding a ceiling on price appreciation, and in exchange, you have a higher percentage or a lower percentage premium, a higher percentage ownership of Bitcoin. So to me, that seems kind of natural. To me, there's also a little bit of risk to essentially owning leveraged Bitcoin. So, I mean, ultimately, if we think about real estate is often a leveraged home purchase. People usually put 20% down, maybe 5% down, 20x leverage. But that asset, a home, isn't a 50 vol asset. So high leverage on a high vol asset can, cut the other way as well. So people are aware of that. I think that's definitely something to keep in mind. And that's why the vol was so high. I mean, there's a good reason. Vol is also downside protection. So there's just something to keep in mind there.
Yeah. I mean, I think it's a really interesting story, but like, I mean, at some point, and maybe it doesn't happen this year, but at some point when generally, if you look at the cycle, next year is supposed to be a tough one for crypto, right? Like, so if that is the case, then watch out MicroStrategy, right? I mean, they could have some serious downside, right? If Bitcoin decides to halve 1 year, what happens to MicroStrategy stock? So, I'll certainly be keeping an eye on the vol there. What about kind of ETH? I mean, ETH's had a few little goes at trying to catch up. People are thinking that the deregulation side would be great for alts. Bitcoin already maybe kind of played out to an extent in terms of the narrative. But every time ETH tries to have like a 10 or 20% pop, you blink and it just gets whacked again, right? Like, is there any light at the end of the tunnel for ETH?
So this is a great point. So I really like that deregulation narrative for DeFi, for smart contract chains, for altcoin projects, stuff like that. I think ETH has a very peculiar situation going on. So on the one hand, a lot of development's done on EVM compatibility. So a lot of smart contract protocols are built with Solidity or at least an EVM compiler. So there's a huge developer base who understands how to write Ethereum code. And some of that code is now being compiled on Solana and other chains. But what ETH is feeling the pain from is that with EIP 1559, as each transaction is conducted on the Ethereum L1, there's a slight burn of the ETH supply. Now, that burn offsets an ETH inflation rate. So there's a built-in ETH inflation rate, and the hope is that there's enough usage on Ethereum to not only outdo the whole inflation rate, but maybe make ETH a deflationary asset. So the supply would be shrinking. That's where they come up with that sound money, ultrasound money meme for the Ethereum community. Now, what's happened is that a lot of protocols decided to build app chains or L2s that live completely out of the Ethereum ecosystem. So if I think of some like the most popular ones, Derived, DeFi options protocol, they have their own native app chain that's built as part of the Optimism superchain standard. So all the transactions of that whole DeFi ecosystem, which is like number 7 out of all the DeFi projects, all those transactions are conducted on their own app chain, and then state is settled periodically back to L1. Well, that state settlement is not enough of a transaction to keep the transaction burn overall for the network high enough to outdo the inflationary supply. And so a lot of projects are building that themselves that way. So now ETH, the price trajectory changes a lot if you go from an ultrasound money deflationary supply to an inflationary supply year over year. And so that's where the price downside pressure is coming from, in my opinion. That's really what I think is affecting it short term to medium term. Long term, I do think it's good that the ETH ecosystem, the EVM compiler, has a huge developer community, and hopefully it's going to keep growing, and there'll be more VC investments and more DeFi and stuff like that, and maybe they'll figure out another burn mechanism or reduce the inflation rate. But as it stands right now, I think that's the source of the price underperformance.
Cool. So then you're not thinking it's a no-brainer that ETH has loads of outperformance this year, basically, as the Trump administration comes in.
There's a yeah, I mean, it's a little hard to say because there could just be like a wave of buying on enthusiasm nonetheless. But I think there's a fundamental reason why we've seen the underperformance so persistently. And I think that fundamental reason is flipping from decreasing supply to inflationary supply.
Okay, yeah. So that again, so that means if there was a wave of optimism, it's probably another fading opportunity if we look at how it's played out so far, right? Every time it pops 20%, you just whack it out. Every time it pops 20%, you do pretty well, right?
Yeah, I mean, that's a great way to look at it. There's definitely a couple plays there. Yeah, ETH also has a higher implied vol. I mean, a 10 point premium over Bitcoin right now, where I think.
Well, I think it was 20. I think it's 20 in the front end right now.
I mean, that's even better then. So like if you want to sell calls on ETH to buy calls on Bitcoin, that could be an interesting trade. I also think the forward term structure on ETH and Bitcoin is very, very similarly priced, which means that you can essentially, I think on Deribit, you can essentially use staked ETH as collateral. So that has a natural yield to it. And then you sell the ETH future against that. So you essentially have a outperformance yield because you get the same basis on the short future plus the yield of the staked ETH as the collateral. So that's an interesting type of trade. But yeah, in terms of straight trending higher, I think it's a tough call.
Yeah. What about flows? Have you done much sort of analysis on the kind of flows that are dominating crypto options these days? From what little I see, it's very much been call dominated. People generally parking their bullish bets in like March onwards, thinking that we might get some near-term consolidation and then we go again, right? So anything else that I'm missing that you're noticing out of the flows?
Yeah, so I actually just did some analysis on that recently. So it's very interesting. If I break out the flows between on-chain versus block, on-screen versus block, on-screen flows are really buying March 100K calls and March 120 calls. So they're vol buyers, upside. If I look at block trades, the biggest block trade aggressors we're seeing selling 55K March puts and selling 55K June puts. So also bullish, but vol sellers. And so the vol selling side to me makes a lot more sense just because of the reasons we talked about already. And the sort of out of the money March call buying, anytime, especially with those out of the money kind of wingy options, any time decay and collapse in vol just quickly juices those away. So I wouldn't want to be on the side of on-screen buyers. And I think being on the side of institutional vol sellers makes a lot more sense. And I kind of think that also shows a little bit of like strong, quote unquote, diamond hands. They're probably willing to take delivery at 55K if we're being realistic. So to me, that's kind of a very less speculative and more sound kind of trade. And then obviously the vol collapse is very good for short 55K puts. Those are pretty wingy as well.
But the call skew, it's amazing how the call skew is so persistent in that medium term part of the curve. I think me and you have talked about it before, right? How it's like it just offers you such an amazing hedging kind of pricing, basically, where you've got the funding of like 10% plus when you go out 6 months. Yeah. You've then got this risk reversal that is bid for calls relative to puts. So if you own crypto, you can layer a risk reversal over the top of it and have the most attractive break evens ever, right? Where you've got like 50% plus upside on your, before you get taken out on your short call, and you get to own like maybe 20% out the money puts on the downside, right? For free.
Yeah, you have a built-in caller with a built-in like 3-to-1, 2-to-1.
Yeah.
Or situation. That's one of the trades that I had noticed even like early on in crypto when they first listed ETH options back in April 2019. I was definitely ETH focused, and that caller trade was a 3-to-1 payout ratio. And I agree, like it's so interesting. And to me, that is indicative of a market that's a little bit lopsided in the sense that there's probably not enough capacity on the vol selling side to take up all that sort of FOMO flow call buying.
See, I think Michael Saylor should be doing those collars. I think it's the biggest no-brainer on the planet for him to do those collars, right? But he doesn't want to sell his crypto, does he? So if he gets called away, he'll be upset.
That's a great point. Yeah, I mean, I think those are really good trades.
Yeah. He'll be wishing he did it next year when the market halves. But we'll cross that bridge when we come to it. All right. So the other thing I wanted to ask you was IBIT options. So they got listed late last year, the spot ETF, the BlackRock one. And the question was, was that going to open up a whole new avenue of flows in crypto options, like the US retail option user base, where they're going to pile in and buy a load of upside and a load of calls and drive Bitcoin higher from these flows? Have you seen much impact there? And how has that evolved over the last few months since they've been around?
Yeah. So what's really cool about IBIT is if you look at like the top 10 instruments or tickers with option trading flow, they're really right up there. Maybe they're like 11 or 12. Number one's Nvidia, Tesla, kind of those big names. But out of all the equity tickers that have options trading on them, IBIT's in the top dozen. I think the first day of IBIT trading was something like 40% of Deribit volume, which was pretty interesting. So I definitely think this is and as we've all seen, the sort of asset under management outperformance inflows into IBIT. It's like one of the best performing ETFs ever. If not the best. I don't remember what the exact.
Probably the best. Yeah.
Probably the best. So I think that narrative is definitely holding true. I definitely continue to think that IBIT options are sort of the vol event or the moment for crypto vol trading. In terms of where the stuff opened up, I think you and I were talking about this right before jumping on, but it's very interesting to see where the volatility curves opened up on IBIT versus where they're lining up on Deribit. So, Amberdata, we were able to get the IBIT volatility surfaces and data day one. And we can also look at the flow and inspect all that stuff. But something that was really interesting to me is that IBIT vol, even as far as 1 year out, was trading about 2 vol points above Deribit vol. And in my opinion, it should be trading below Deribit vol. And the reason why I think that is because if you're gamma scalping Deribit vol, the basis is positively correlated to spot prices. So what I mean by that is that as Bitcoin rallies, the funding goes up and the futures basis goes up, which means it's almost like extra juice to spot. And then when markets crash, the basis compresses and sometimes goes negative, such as COVID, 2020, things like that. So that's extra juice on the way down. So there's actually more realized vol to the future than there is to the cash market. And so IBIT is a cash market product. And so despite sort of that differential, IBIT was trading above. Obviously that's flow driven, but to me, that creates an interesting opportunity.
Yeah, it's interesting because when I saw it first get listed and I was like, okay, it's trading at a premium to Deribit, I thought that made sense because I was like, there's clearly less supply of IBIT options. There's this whole user base now who can get access to leverage on Bitcoin via owning calls. So there's this demand for calls across the curve, and there's no natural seller of it right now because, it's still an evolving, developing market. But yeah, I didn't think about the idea that, there's like a potential arb there where if it's trading too expensive because there's no supply and there's a load of natural supply on Deribit that keeps the Deribit vol somewhat suppressed or fair value, that there's an arb in the fact that you can capture more realized volatility out of the Deribit futures than what you're losing on the short leg of an IBIT short vol position where you're just hedging it with IBIT ETFs basically. So, but I think that's the kind of trade that I guess, is going to be for a vol arb crypto hedge fund to be putting on, right? If anyone is putting that on. And I guess the question is, versus all of the other opportunities out there in the crypto space, is it juicy enough for them to go after it just yet?
Great point. And the way I like to think about that, because to your point, like who's going to have the infrastructure or the capital to put on that trade? And even if they do, does 2 Vega points even a year out really matter that much? Or at least 2. We'll see how realized does. But in my opinion, at least what you can decide is if you have access to both venues, if you're going long vol, pick the cheaper one. If you're going short vol, sell the more expensive one.
Yeah.
At least simple as that.
That makes sense. That definitely makes. That's kind of how I approach ETH and Bitcoin, to be honest. Rather than putting on loads of spread trades between the two, it's more that if I want to sell calls and ETH vols are pumped, then maybe I'm going to do it there rather than Bitcoin, basically, right? And similarly, if I want to buy puts, I'm going to go for the cheaper vol, right?
Yeah, I'm right there with you. Like, for speaking for myself as a more discretionary trader, that's the simple way to take in that pricing discrepancy. If I'm a market maker and I can lean my book and I can lean my quotes a certain way and take advantage of that spread, hey, good for them. But that's not the infrastructure setup that I'm working with. So
before we let you go, why don't you tell us what's going on at Amberdata now, right? I'm sure you guys are doing lots of interesting stuff and developing new things, new products for people. So time to plug it, man. What are you guys doing over there?
yeah, absolutely. Well, thanks, Imran. So one of the coolest projects, well, there's a couple projects that are layered in together. So we talked about having IBIT data. So we also support MSTR, BITO, BitX. We have all these datas, volatility surfaces, flows, historical data to essentially analyze all that stuff. So really excited about the TradFi markets and including those. So we support the ETFs and crypto-related equities such as Mara and Coinbase. So that's very interesting. Another element that we spent a lot of time developing is we decided to do volatility calibrations for altcoins. Now, the way that we do that is that there's no altcoin market, like options market to reference. A lot of people want to trade these things, so they essentially get quotes from OTC desks, and different OTC desks will basically, quote what they want based on sort of their own personal exposure and desires. What we've done is we've essentially done a pretty like standard, robust methodology. Ewan Sinclair is actually the lead quant on this. So GigaBrain working behind the scenes on that. So what we do is we essentially do a co-integration test against all the liquid options in the equity universe. We figure out where is this altcoin most co-integrated to. We take the top 5. That gives us the good like smile shape of the vol surface. Then we adjust it based on Garch. So we take some Garch vol, do some modeling, and then we can shift it up or down. And finally, we imply the variance risk premium that we see in Bitcoin under different environments, contango versus backwardation, high vol versus low vol, things like that. And then we apply that same type of variance risk premium and then same type of forward term structure. And from there, we get a really good, robust altcoin volatility surface. And so the hope is that, well, most of the industry can at least reference this. We can provide sort of neutral marks for the industry for people who are trading altcoins. And then we have customers such as Derive, who are just going to be listing a bunch of different altcoins on chain. So the community will be able to trade all this stuff. So very excited about that.
And they'll be using your models to kind of to have a baseline for it.
Yep, to run the risk engine, essentially to have fair value marks. And,
amazing.
Yeah, so that's pretty cool. And then we validate all this through Deribit. So we use our model to model Bitcoin vol. We use our model to model ETH vol, and we see where our model comes in versus Deribit, and it's very, very tight. So it's a very good model. And obviously it's a big problem. How do you create a vol surface for something where there's no options market yet? And so it's kind of guessing, testing the wind.
Yeah.
Technology for that. So very excited about that.
Yeah, and then I guess you need some big market makers to basically buy into your methodology and say, you know what, I'm happy to put some capital against these marks and make markets in this stuff and actually take on some risk. And then it grows basically, and liquidity grows. Because at the moment, as far as I'm aware, Deribit liquidity on things like Solana is limited to like a month expiry or something, basically, right? Whereas, if for me, it's much more interesting if I can get hold of 6-month calls on a name like Solana, where I can own it for a bit longer term and get some real leverage to like an outsized doubling of the spot or whatever, basically. But for a 1-month option, the odds of it expiring are so worthless, are so high because the decay is so quick on that thing that it's not as interesting to me, right? So I'd love to see more liquidity enter that altcoin space.
Yeah, I think there's going to be some really interesting trades. I mean, even like Bitcoin ETH options, like the ratio, that's an interesting market. And then you could extend this thing to like baskets of different altcoins and stuff like that. So very excited about that. And then we have a pretty big announcement coming out. I'll just tease it here, but we're gonna announce it with Deribit. So that's going to be pretty exciting. It's with respect to our GUI platform. So really excited about how that's going to line up. And so yeah,
cool. Little teaser there, little hot exclusive off the press.
Yes, absolutely.
All right, buddy, it has been a pleasure catching up with you as always. Let's not leave it so long next time. Yeah,
absolutely.
Thanks a lot for coming on the show, man. I'll catch you next time.
Thank you so much. See you next time.
Yeah, so good chat with Greg. I always love catching up with him.
Yeah, I love Greg. And you know what's brilliant about Greg? Again, just got a real sort of calm demeanor, able to step back, never gets carried away either way. When there's me getting really bullish, he'll always offer like some balance to it. Yeah. So no, like really like some of the stuff he said. I thought thought some of the points he made around ETH were quite interesting.
Yeah.
Um,
It's basically sell the pop if we get one.
Sell the pop, sell the vol pop maybe, which is interesting. Well, one thing again where I would maybe push back a little bit about that, I get his thing about the inflation deflation like asset narrative, and with all like the layer twos and all that taken away from that deflationary aspect. I do think obviously you spoke about like the regulatory environment and actually that being a positive for DeFi and all this sort of stuff. I also think the rate environment, like right now with yields back up here, DeFi yields look less attractive.
True.
So if I'm correct in terms of all that reversing, then I think DeFi yields look attractive again. DeFi activity explodes and then ETH starts to perform like pretty well again. So
Right.
that'd be my one kind of pushback. But I thought
I just feel like the way ETH trades is just like it keeps disappointing. So until you get a serious technical break of that ETH Bitcoin cross rate, where you can buy into the idea that, okay, this downtrend that's been in place for ages is broken, but it's just false break after false break at the moment, right? So it's just hard to really get on board with that. And given that the vol spread is like 20 vols in the front, if you do own some ETH, it feels like call overwriting is a bit of a no-brainer right now.
Yeah, and like you bleed to death from paper cuts as well, right? So you keep trying to play this trade and it's just not kind of working, and perhaps there's easier trades out there, I guess.
Yeah, I mean, we did see a bit of, we do still see quite a lot of bullish activity in options flows in ETH. So even this week, we've seen some March call spreads getting bought, and people are opportunistically using dips to try and get long exposure via options.
Yeah, but
I almost feel like that might be because they don't have the conviction to just buy the asset. So they're using optionality instead.
Yeah.
Because they know that this thing's just been trending not in a good way. So in case it pops, we want some exposure.
I thought as well, something was quite interesting that Greg brought up. So when he was saying that essentially retail on screen at Deribit are buying calls, like 100K calls, he's saying like 110s or whatever.
Yeah, whereas the instos are selling on the block.
They're selling like 50K puts and all that sort of stuff, which makes a lot of sense. Like very much how I'd expect some of the instos to trade. But again, despite the noise of the last week, where God, like you look on Twitter and stuff, it's like the world's ending. Despite all of that, actually, like the actual flows remain, looking for a breakout and
yeah, the put buying is always very short dated.
Yeah.
Like, we're talking about using up to 2 week options, puts or put spreads. So people are very non-committal on buying puts. They're just like saying, okay, just in case this thing breaks down to the next support level at like 82K or whatever it is, I want to have some protection. But if it flies again, I don't want to waste too much money, basically. Yeah. I don't want to lock in my protection 3-6 months out or whatever.
Yeah. Joe, something else quite interesting, just to wrap things up. And as someone who's not particular, like, I mean, my technicals are kind of okay, but I guess quite amateur really. But so I was looking at yesterday, I just thought it was interesting. So, like the RSIs, the momentum indicators. So the last time the RSIs were this oversold in oversold territory for Bitcoin was early September, when we bottomed out. And if you remember, in September it was all about the seasonality and everyone was trying to get short. And then it was up only from there. And the last time, equally as well, the RSIs for the S&P were this oversold was at the beginning of August, when we had the funding trade blow up and everyone thought the end of the world. And it marked the lows on both of them. So my amateur techs tell me that perhaps we're close to seeing a bottom in this market. So yeah, I still feel pretty good. Obviously, it'd be remiss not to acknowledge the risks out there right now with this yield blow up. And if we do get a deeper sell-off in bonds, higher yields, then things could be a bit choppy for a bit. But and CPI tomorrow is going to be huge. But
yeah, for sure.
Yeah, still feeling good.
All right,
everyone relax.
Yeah, everyone take a breath. Don't worry, not panic stations just yet. It still very much looks like a correction in a broader bull market. Whether the correction is done and we've seen the lows, or whether it extends another couple of months into March, that is anybody's guess. But generally, the structural bull trend does seem to be intact. So we're still calling for higher levels throughout the rest of this year. All right, guys, that's it for today's one. Thanks for watching. Don't forget, like and subscribe, and we'll catch you guys back next week.